Okay, we're going to review the quiz for those of you needing to go over this, and here we go. Let's take a look at the first question, which was asking how much of the goodwill impairment was recognized. So we want to know the impairment amount. In order to do that, we take a look at the fair value here of the known assets. We come up with a total of 190. We compare it to the new total of 195, which the problem tells us, which means the new implied goodwill is 5. The carrying value was 60, so the write-down is 55. End of question 1. Number 2 in the hit parade is we want to know with the acquisition method of accounting, what happens? So number 1, expenses related to business combinations are expensed, and that's referring to the accounting and legal, and that is true. Number 2, stock issue costs are treated as a reduction in the issue price, and that we learned in class is a debit to additional paid-in capital, which in effect lowers the issue price of the stock. Think about the entry. The entry works like this. One second. The entry works like this, that you are debiting the purchase price or the investment account. You're crediting the common stock that you gave out and the paid-in capital. For numbers of the value of the stock, but really the cost of issuing the stock brings the actual price of your stock down by whatever it is, let's say 0.10% or something like that, and so that the net going to the investment account is net of this because it costs you that much to issue the stock. So the answer is B. Alrighty, moving right ahead. Let's see what we got next. We've got Tower Inc. owns 30% of Yale, so that's the equity method coming up here. What amount is in the intra-entity inventory profit? So we're looking for, in this particular case, we're looking for what amount of unrealized profit was left at the end of the year at the 30% amount. So to do that, using my methodology, which I went over in class, and it's a good, you can use the textbook method or my method. My method just makes it a little bit easier. You put down the sales amount as a debit because you're going to undo the sales. And how much is the sales? Let's see. The sales was 120. Cost of goods sold of that sales was 66. Now we're looking for a debit of 54 to balance. The debit can go one of two ways. Either cost of goods sold or inventory, which is going to represent the unrealized profit. And so to figure it out, we need to know how to break this down between the two parts. We need to know the percentage of inventory remaining at the end of the year. Turns out they sold everything except 24, and that's 24 of the 120. And where's my trusty calculator? I can't find it right this second, so we'll use the next trusty rusted calculator. And 24 out of 120 is 20%, so 20% of 54, which is the credit we're looking for. 10,800 is the unrealized profit in total, and the rest of it goes to cost of goods sold to balance the entry. Now we have the unrealized profit. We have to take that number at 30%, and 30% of that number is 3240. Hence, answer E. Okay, carry forward. Here we go. This one's another 30% equity method account question. And this one's theory. If they sold it and went back to fair value, see, they sold it, no longer had the ability to exercise, so they're going to go to fair value accounting. What happens then? So that's easy. It's D. Use the fair value method in the year of the sale, because it was sold in 2014, and future years forward, but there's no retrospective adjustment. No retrospective adjustment. The reason for no retrospective adjustment, if you think about it, is because at the end of 2014, using the fair value method, you're going to adjust the account to the fair value. So you'll be right where you need to be by the end of the year. So you don't need to make any retrospective adjustments. Like the textbook approach, when it goes the opposite way, when you were doing fair value up to equity method, you would make a retrospective adjustment, but that's no longer the gap. That has been changed. There's no retrospective adjustment for anything. So that sort of makes these problems easy. No retrospective adjustments. Okay, number 5. Let's see what we got here. And this is the acquisition of assets and liabilities. We want to know what happens with goodwill, or what additional items need to be recorded, and how will it be accounted for. So what we got? Let's see, we got $470 in cash is the purchase price, and then you subtract out the net of these. The net of all those is 170, 320, so that's 490, and it comes down to 440. And the difference between 440 and 470 is an unexplained 30. And we now know the unexplained 30 is goodwill, and that's capitalized and tested for impairment is the best answer there. Answer A. Okay, company acquired in number 6 cash, and for all the outstanding common stock of company Y. How should they account for it? In the assets of inventories and long-term debt. Everything gets valued to fair value in the acquisition method of accounting. Them's the rules. That's what we did. We discussed that in class even today. That on date of acquisition we book up. That's what this is known as, the book up entry to acquisition date value. Number 7. Okay, this is just a theoretical equity investment, equity method accounting question. What do you do with the excess depreciation? When you're doing equity method on the books of the parents, it's strictly a reduction of the income from the investee. Answer A. Just check the textbook, chapter 1. Okay, number 8. Moving right along. Let's see what we got here. We got a little more complicated question. Looks like we have purchase, 30%. Significant influence, so that's equity method. We've got assets 400, liabilities of 100 on the date of purchase. As part of its analysis before buying these shares, Big determined Little owned a patent that hadn't been recorded yet and has a useful life of 5 years, and the value is 20. So let's see what we got. We want to know what investment income is going to be reported. So let's put it all together. If the income by the subsidiary was 70, and we have this $20,000 that's going to be amortized over 5 years, then 20 over 5 means a $4,000 adjustment each year. At 30% is $1,200. So that's going to be our adjustment to the income. What is the income for us? It's 30% of the 70, and that number, 30% of 70, is $21,000. So that's the income we report, but then we adjust it by the depreciation, and this will be depreciation reducing income because the value of the patent is getting amortized. So we reduce to 21,000, and we get the answer 19,800, and we're done with the multiple choice. See ya.